So materiality, what is it? Why do we care? And who is we? You'll see, there's a lot of stakeholders in the financial reporting process, and the legal profession has a definition with a substantial likelihood that the fact would be viewed by the reasonable investor as having significantly altered the total mix of information available. One of the Supreme Court issues. The auditors also have, the AICPA provides them with the definition. Won't read everything out there. The preparer community, the accounting profession, the FASB also has a definition. Focus on this one. The omission or misstatement of an item in a financial report is material if, in the light of the surrounding circumstances, the magnitude of the item is such that it is probable that the judgment of a reasonable person relying on the report would have been changed or influenced by the inclusion or correction of an item. Kind of a run-on sentence there that the accounting profession tends to gravitate towards. Also, the SEC, they're kind of almost the final judge and jury here for the most part in evaluating how the materiality gets viewed. There's a little more simple, definition there of those matters, which there is a substantial likelihood that a reasonable investor would attach importance. So, if you kind of read through the definitions, there's some definite themes, but, they're very subject to interpretation. With the preparer community, you guys preparing your 10Ks, how do you determine materiality? Is there one person in the group there that figures it out, or is it kind of a group decision? It should really be driven by what your investors think and put yourselves in their shoes. If they're the main users of the financial statements, what do they consider material? We'll go on the next slide. So again, materiality is not all about the numbers, and there's a concept which the SEC views of in actually the accounting profession of qualitative versus quantitative, and such straight quantitative measures or rules of thumb is hey, if it's less than 5% of net income, then it's not material. That can't be the only assessment, and you can't stop at just that. Quantitative measurement. There also is an element of what's called qualitative. So something, number wise might be small, but it might have a material qualitative impact on the financial statements. The SEC's guidance lists out the bullet points there. I won't go through all of them, but if you kind of consider some of those, does the rather small dollar amount of an error change trends in earnings, or do we go from a loss to a gain if we really got a thin profit margin, or is it something buried in a segments? If you have multiple segments in your company, but one of them's more the big profit leader, does a small error in there really influence the decision makers or the users of the financials if all the other divisions or segments are break even? Thing we run across a lot is loan covenants. If you default on your loan covenant, that tends to have a very big impact on the organization if your debt could be called. So, if it's, maybe a couple $1,000 either way, and you're either, meet that tangible net worth covenant or you don't, that could be a material impact for the company. And again, this list isn't exhaustive, and there's, one of the assessment tools we use has 19 factors that consider of what's qualitative. And if you guys in your practice think of anything else that could be inclusive here, if you want to dump it in the chat room to share with everybody, but it has to go beyond what just the numbers tell you is a quantitative assessment of whether a transaction or error could be material. So next slide, a little polling question here. it's permissible to use a standard rule of thumb measurement, such as 5% of net income, in assessing materiality, as long as we disclose it, true or false. All right, I think we probably got the answer here, and it's actually false. I wrote this polling question and thought it would be really easy for everyone. And then when I was kind of going back through my slides and notes, I said, well, maybe that's not too black and white of an answer. If you think about the definitions and what a reasonable person thinks and who's the user of the financials, that's a broad range of people. You could have really institutional investors that, could be, the pension funds, or it could be the, sole retail investor. So maybe if you tell them what your definition of materiality and what you did, maybe that's not a bad way to go in the future. I don't know, but but I think the SEC today would still view, you have to go through those qualitative assessments. So a couple further considerations. Just be mindful of a series of small intentional misstatements. Managing earnings, not one thing might, cause some heartache, but if you start having a series of intentional errors, it could run you afoul of maybe some of the books and records provisions the SEC kind of holds the users or the preparer community and companies accountable for. Assessment of individual misstatements themselves and in the aggregate. So if you have a number of errors, you need to kind of look at those all added up together. We generally see, one small error, and then there's another one, it's additional expense, and another one's additional expense. Well, if you add those up over time, they might make a material effect on your financial statements. As auditors, sometimes we get accused of finding errors and misstatements all going one way to the negative and not finding revenue or other income. But we do, keep an objective approach to that. And if we do see, positive accounting misstatements, we kind of have to aggregate those together and see what they net out to. But also, if they do net out, is that okay if the net income isn't materially misstated, but one particular line item like revenue or SG&A is materially misstated on its own? So you do need to kind of take a holistic approach and look at any errors you identify individually and into the aggregate and how they affect the overall financial statements. So as I think Rick mentioned in the intro, evaluation of errors in prior periods come up. We kind of the community has called these, little R restatements is, just adjusting your prior year financials when you kind of do your current year audit because you ran through something where you found an error in the prior year and don't want to go back and amend the prior 10K and file an 8K saying you can't rely on our financial statements and amend all the Qs and going through that process, which tends to, kind of have a detrimental effect to the stock price and the overall, financial reporting credibility with the company. This has been a trend over the last couple of years. The SEC has seen a lot more of these, and they have emphasized it's, you need to be objective in evaluating whether an error is material. Also to consider the effects on your internal control over financial reporting. If you're in your current period financial close cycle and you discover an error that you didn't catch last year, do you still have a control deficiency that you need to evaluate for disclosure as a material weakness? Also, the quantitative effects, as they increase, it gets harder, as that dollar amount gets higher, it gets harder to, argue away the qualitative aspects of why that error isn't material from the prior year. And really from, a lot of the arguments that people make is really the passage of time. Hey, it was last year's financial results. It's in the rearview mirror. Where the investor community is looking forward. Here's our current period. It's not really a lack of, the relevance of that prior information isn't important. And they've kind of the enforcement division kind of doesn't wholeheartedly buy that as one argument, because people look at historical financial statements and trends, so they want the prior years to also be correct when they have some integrity in the financial reporting. All right, just a couple closing thoughts here before we go to the next presenter. As auditors, we deal with this a lot. I would say absolutely every single audit, but the vast majority do have errors in them that either we discover or the client discovers as you go through the close process, and evaluating those in the aggregate individually and what's qualitative. And we go through that all the time. So, we encourage our clients to have some upfront discussions on that. Is, hey, can this potentially be material? Where's this going? What qualitative effects should we think about? So, so it's a open discussion we like to have, and not, hold all our cards to the end of the audit committee meeting and come out with, well, here's the misstatements. That's just not a very good approach to getting the best answer for our clients and the users of the financial statements. The desire to avoid a restatement at all costs can't be the driving principle. The SEC would kind of expect you to be objective in going through a thorough assessment process before you reach a conclusion, and not have the conclusion and try to back yourself into it. And then future applications of materiality as we get into more ESG type disclosures and that type of thing. And, are you zero carbon, or what's your carbon footprint? How do you measure the materiality of, whether you're zero carbon or not? Is it, negative 0.5 or there's not a whole lot of numbers going into that. So that's probably going to have to evolve over time, as the disclosure rules continue to evolve. All right, with that, we'll close up our materiality discussion. And